Welcome to Epoch Report, where we look past the headlines at the structures underneath. Today, the debate over Treasury buybacks and whether they could trigger a yen-style devaluation spiral. With long-term yields hitting 6.7% and an economist warning in Fortune, the question is whether Besant's buyback plan is routine debt management or a signal of fiscal distress. The argument hinges on whether buybacks shrink long-term bond supply, push investors to shorter maturities, and ultimately pressure the dollar, as Japan's experience with a 30% yen decline suggests. But skeptics counter that buybacks are voluntary, the dollar's reserve status is unique, and high yields reflect inflation and deficits, not manipulation. The real tension is whether buybacks are a stabilization tool or the first step onto a track of competitive devaluation. Now, let us get into it. An economist just warned that Besant's buyback plan could trigger a yen-style devaluation spiral, and that hits your grocery bill directly. Fortune.
Buybacks are just debt management. Mature a bond early, issue a new one. No new money created. How does that devalue anything? The mechanics matter less than the signal. When Treasury buys back its own debt, it shrinks the supply of long-term bonds and pushes investors toward shorter maturities or riskier assets. Shrinking supply should support prices, not crush the dollar. Japan's problem was the BOJ buying bonds directly, not the finance ministry managing maturity. But the buyer matters. If the Fed stands ready to take the entire curve, buybacks become backdoor QE. Japan's yen lost over 30% amid similar policies, BOJ data. That's a leap. Japan had negative rates and a fragile economy. The US has 4% yields and strong growth. Investors aren't fleeing dollars for those reasons. Yet yields hit 6.7% on the 30-year, Bloomberg. That's not strong confidence. That's the market demanding a risk premium on U.S. debt, which pressures the budget further.
High yields reflect inflation expectations and deficits, not buybacks. You're correlating two things that share a common cause: fiscal irresponsibility.
Fair point. But buybacks are the chosen response to that fiscal problem. If you can't cut spending, you manage the debt profile. And buying back long-term bonds while issuing short-term bills is exactly what a stressed sovereign does before a crisis.
Or it's what a smart treasurer does during a yield curve inversion. Buy high, issue low, save billions in interest. No devaluation required. Saving interest only works if the market believes you'll repay. When the 30-year hits 6.7%, the market is telling you it doesn't fully believe. Buybacks remove the long end so the government can roll debt at shorter, lower rates. That's a devaluation of the debt itself.
But devaluing debt is not devaluing the currency. The dollar index has been range-bound for months. Where's the actual exchange rate movement?
It's not instantaneous. Japan's slide took years. The mechanism is, buybacks signal the Treasury wants lower rates. The Fed accommodates. Real yields fall. Foreign capital leaves. Dollar follows. That's how it plays out.
But the Fed is not accommodating. It's running off its balance sheet. And Besant hasn't said anything about wanting lower rates. You're attributing motives he denies.
Actions matter more than statements. Announcing buybacks while yields spike is a clear signal. He can deny it all he wants, but markets price the behavior, not the press release.
Here's a cleaner explanation. The Treasury holds surplus cash from the IRS settlement. It's using buybacks to reinvest at higher bills, a portfolio optimization, not a devaluation plot.
That would be plausible if the amounts were small. But the plan is substantial enough that economists are warning publicly, in Fortune, not fringe blogs, about a yen-style spiral. That's a reputational risk no Treasury takes casually.
One economist's warning doesn't make a trend. I can find you 3 economists saying it's fine. The yen comparison also ignores the US dollar's reserve status. The world needs dollars more than it needs yen.
Reserve status is an assumption, not a law. The U.S. has been testing its limits for 2 decades. Buybacks, deficits, sanctions, each one chips at the pedestal. Japan's reserve status didn't collapse. It eroded gradually until devaluation became permanent.
But Japan's erosion was driven by deflation and demographics. The US has immigration and innovation. The analogy collapses on structural grounds, not just scale.
Granted, the structures differ, but the fiscal math doesn't care. When interest costs exceed growth, every tool, including buybacks, becomes a way to manage a debt that can't be repaid. The dollar's value is a reflection of that math.
But interest costs are a problem solvable with growth, and buybacks that extend maturities can actually reduce near-term refinancing risk, a stabilization tool, not a destabilization one.
Stabilization presumes the buyer of last resort. If the Fed stays away, buybacks just thin the market. Bigger yield swings, more volatility. That's not stable, it's fragile. Either way, the market's moving against you.
So your thesis requires either Fed complicity or market fragility. If the Fed refuses, the buyback fails. No devaluation. If the market is fragile, high yields already reflect risk. Buybacks don't add it. You can't have both mechanisms work simultaneously.
But that's precisely the bind. Treasury wants lower rates. The Fed wants independence. The market wants higher compensation. Three-way tension means the system is unstable. Buybacks are the Treasury's move in that game. Not decisive alone, but a step toward a weaker dollar.
That's a narrative, not evidence. No data links buyback announcements to exchange rate movements. You've shown a mechanism that could exist, not one that does.
You're right that the direct data isn't there yet. But the 6.7% yield is data. The yen's 30% fall is data. BOJ. The economist's warning is data. Fortune. The pattern across data points is the evidence.
Pattern matching across 3 unrelated data points is how you get false confidence. The yen fell because of BOJ policy. The yield rose because of supply. And the economist is making a rhetorical point. None of that is a dollar devaluation.
But policy, supply, and rhetoric are exactly the channels through which debt crises unfold. Japan's experience is the closest precedent we have for a developed country testing the limits of fiat debt. And the pattern was denial, then accommodation, then devaluation.
Denial, accommodation, devaluation. That's a script, not a law. What if the US just grows out of it? Real growth erases debt ratios, and buybacks are a footnote, not a driver.
Growth at 2 to 3% cannot outrun a 6.7% yield on the long end. The math doesn't work. That's why buybacks are being considered, as a tool to force the math into submission. That is the definition of financial repression.
Calling it repression is loaded. Repression is when the government forces pension funds to hold bonds. Buybacks are voluntary market operations. No one is forced to buy or sell. Voluntary, yes, but when the alternative is watching your fund lose value as yields spike, voluntary becomes a constrained choice. That's how soft coercion works in financial markets. You're never forced, you just have no good option. That's still a far cry from a yen-style spiral. The dollar is the world's primary reserve. Even a 10% decline would be manageable. You're predicting a crisis from a toolbox. Every devaluation started manageable. Japan's wasn't a cliff. It was a 30% slide over years, BOJ data. By the time it's obvious, the groceries have already gotten expensive. The viewer pays the cost during the slide, not at the diagnosis. But the alternative, doing nothing while yields spike, is a debt spiral that's arguably worse. Buybacks at least manage the timing. You'd rather have a controlled devaluation than a default, wouldn't you? That's the argument in favor. But the risk is the devaluation becomes uncontrolled, a spiral, not a plan. The question isn't whether buybacks are the only tool. It's whether they're a tool that can be put down once started. And your evidence that it can't be stopped is what? Japan never tried to regain yen strength. They chose weakness for exports. That's a policy choice, not a trap. But the US faces the same temptation. A weaker dollar helps exports and reduces the real burden of debt. Once you start, the political incentive is to continue. The trap is political, not mechanical.
Buybacks are the first step onto that track.
That's a political speculation, not an economic one. The Treasury has every incentive to keep the dollar strong. It's the source of global power. Weakening it deliberately would undermine the US's geopolitical position. But power erodes when the debt becomes unmanageable. Strong currencies are nice, low interest costs are necessities. When they conflict, the necessity wins. That's not speculation. It's every sovereign debt crisis in history.
Every crisis you cite involved either hyperinflation or lost access to capital markets. The U.S. borrows in its own currency and has unlimited demand from global savers. The analogy fails at the starting line.
Unlimited demand is what people said about Japanese bonds in the 1980s. Then yields rose, and the reality set in. The 30-year at 6.7%, Bloomberg, is an early indicator that the U.S.'s unlimited demand has limits.
A yield at 6.7% is high, but it's not a crisis. The U.S. has had rates this high before and not spiraled. You're treating a tight market as a terminal condition.
True, it's not terminal by itself, but combined with buybacks, which reduce liquidity and signal desperation, it creates the perfect conditions for a loss of confidence. The yield is the symptom. The buyback is the treatment that's actually the disease.
That's a clever line, but it's rhetoric masquerading as analysis. If the buyback is the disease, then the solution is simple. Don't do it. But the Treasury is doing it because the alternative, an unmanaged maturity wall, is worse. It's the least bad option.
Least bad option in the short term, yes. But the argument is about the long term. And there, each buyback makes the next one more necessary, like a drug that requires a higher dose. That's the devaluation spiral. Not a single move, but a trajectory.
So your thesis is ultimately about intentions, not mechanics. You're predicting the Treasury will become addicted to devaluation, but there's no evidence Bessent has that goal, and a lot of evidence he wants to stabilize markets. Your spiral is a hypothetical, not a forecast. It's a forecast based on precedent. Japan didn't intend a 30% devaluation either. It just followed the logic of buybacks and low rates. Intentions are almost irrelevant. The incentives take over. That's what makes the warning credible.
But Japan's curve was deflationary. America's is inflationary. A dollar devaluation here imports inflation, which hurts the same groceries you're worried about. No Treasury would voluntarily sign up for higher food prices at home.
That's the strongest objection you've raised. Devaluation imported inflation would hurt actual voters, and that's a real break on the spiral. But it's also a break that's already been tested. The U.S. has run trade deficits for decades, accepting import inflation in exchange for cheaper goods. The question is which pain voters feel more, high prices at the store or high yields on the debt?
And you think they'll choose debt yields over grocery prices? That's rarely how elections work. Politicians respond to the pain they hear most, and it's the checkout line, not the bond market.
But debt yields translate to mortgage rates, business loans, and government services. When the budget is squeezed, taxes rise, or services cut, that pain lands on the same voters. The bond market doesn't stay in the background. It forces its way into every part of the economy.
Which argues for a balanced approach, not the devaluation spiral you fear. Buybacks that smooth maturities, combined with fiscal restraint, could avoid both extremes. You're presenting a false dichotomy, either devaluation spiral or default. A balanced approach is the ideal, but this administration has shown no fiscal restraint. Deficits continue, and buybacks, absent restraint, are not balanced. They're a cover for continued borrowing. That's the gap between the ideal and the likely reality.
That's a political judgment, not an economic fact. Maybe this time restraint arrives. Maybe deficits shrink. You can't build a devaluation thesis on a forecast of continued irresponsibility. That's hope masquerading as analysis. But what have the last 5 years shown you? Deficits expanded during growth. Buybacks are now the tool. The burden of proof is on those who believe the government will suddenly become disciplined, not on those who see the trajectory. Buybacks fit the pattern. Restraint doesn't.
So your final position is buybacks are a warning sign, not a mechanism. You're using them as a banner for broader fiscal anxiety. That's honest, but it's a diminished claim from where you started. Devaluation spiral sounds stronger than fiscal warning sign. Maybe so, but a warning sign is all you get before the spiral. Japan's buybacks were the warning sign. 20 years later, the spiral was undeniable. The dollar doesn't have to collapse tomorrow for the warning to matter. It just has to start the slide today. But if the warning is decades away, your grocery basket cost is a distant echo, not an imminent hit. You're asking households to worry about something that may never arrive. Crises feel real only when they're here. That's the tension. The cost is real but spread out. The warning is urgent but distant. The buyback debate is a proxy for whether voters care about the slow decay or only the final collapse. History says they only act at the end, by which point the groceries have already doubled. Then the buyback isn't the story. The debt trajectory is. Buybacks are just a footnote in that narrative. You could remove them entirely and still have the fiscal problem. So why focus on the tool at all? Because the tool reveals the intent. Choosing to buy back rather than to cut deficits tells you which path the Treasury is willing to take. It's not the cause, it's the tell. And tells matter, even when they're small.
A tell, not a mechanism. That's a reasonable final claim. But the conventional reading, buybacks as routine debt management, still stands if the fiscal path improves. Your thesis requires the trajectory to continue. That's a conditional, not a conclusion.
Conditional, yes. But every crisis is conditional until it isn't. The buyback plan is the condition deepening. If the trajectory holds, the devaluation follows. And the warning from that economist, Fortune, is the first public acknowledgement that the condition is already met.
So we've gone from a yen-style spiral to a conditional warning. That's a much weaker thesis than you started with. But I'll concede this. It's the right measure of uncertainty. Whether the spiral arrives depends on choices, not just mechanics.
And that's where we land. Buybacks are not inevitable devaluation. They're a policy choice with a dangerous precedent. The conventional view that they're neutral ignores the context of high yields, large deficits, and a government that's running out of tools. The risk is real, even if the timing is uncertain.
Agreed on the risk being real. But the counter, that buybacks are the least bad option in a hard spot, remains equally credible. The question isn't whether the tool is dangerous. It's whether the situation is already beyond the tool's help. That, I think, is genuinely unresolved.
Unresolved is the honest answer. The evidence suggests worry, not certainty. The 6.7% yield, Bloomberg, and the yen precedent, BOJ data, justify concern, but they don't prove a spiral. What the buybacks do prove is that the Treasury is choosing to manage the debt rather than fix it. That alone should make you watch your grocery prices. Finally, on the unresolved risk, the dialogue concluded that buybacks are not inevitable devaluation, but a policy choice with a dangerous precedent. The 6.7% yield and the yen's 30% slide justify concern, yet they don't prove a spiral. What they reveal is that the Treasury is choosing to manage the debt rather than fix it, a tell that deserves attention, even if the timing is uncertain. That is all for this episode. Thank you for watching. I hope you found it worth your time. Subscribe and turn on notifications so you do not miss the next one. Leave a comment below with where you think this goes. See you next time.